Please join me in welcoming Professor Jeff Abarbanell.
These colors were chosen by Robbie Lahabi. I'd like to thank him as one of the researchers who's just gone from young to old, apparently. I'd like to thank Peter for making my life a living hell for the last 3 days and inviting me to this conference. And I'm going to try to talk a little bit more about financial statement analysis and research and teaching in general, with an eye towards the possibility that there are going to be several more of these conferences over the years, and not so much about any one topic as we go along here. And I want to spend a little bit of time talking about how pedagogy has evolved in financial statement analysis, and then talk a little bit about the interaction with research and sort of what we're doing as researchers, since it sounds like a lot of what motivated this conference was some consternation about what we do and what generations are doing it and how well they're doing it. So I'll try to get as far into the psychology of this as possible. The way I looked at this, because Peter, I must have been one of the 10, right? Not the first 5? You can tell me, I'm a doctor. I'm the first 5. I'm young, thank you. And that's about as far as he went. He called me up and he said, would you make a fool of yourself in front of a large group of people? And I said, sure. And after that, I started to think a few days ago about what this conference was intended to do. And I knew a lot about what Peter had intended when he started to put this together. And I guess the only way I can see it is something like this. It's a conversation. And it's a conversation among curious academics of various vintages, various generations. And we're here to engage each other and share our common interest in research and teaching. And under the undercurrent there is that there's some sort of confusion or dissatisfaction in here somewhere. And in addition, we are going to bring along a few intrepid souls who have crossed over to the real world of investments and standard setting litigation, and have come back to engage us and try to advance our research and teaching in ways that would benefit all of us. So with that in mind, let me start with a discussion here of what it is that I will try to do. I'll talk a little bit about trends and issues in FSA pedagogy, and it is my understanding from having gone to the website that one of the big missions of CARE is to work on pedagogy as well. And I think there's a very close connection here, and I think that when you think about pedagogy and research together, maybe a lot of what we do makes a lot more sense and makes us feel a lot better about what we accomplish as an industry. I'm going to try to come up with some random musings on financial statement analysis. I had a lot of trouble thinking about how to structure this talk and how to kill 50 minutes without anybody getting angry at me. And so I'll try to do that in 45 minutes and then very quickly say some controversial things and then in most cases very vacuous things, and then you guys will have more important things to talk about afterwards. And especially as it comes to this question of the future of CARE conferences, I was interested to hear what Peter just said about how he envisions these conferences unfolding, how they're going to, what they're going to focus on. And to some extent, as you were saying it, I kind of got that old Spilkus in the Connecticazoid. It sounded an awful lot like what we do a lot that creates some of the angst that I'm talking about, in the sense that the way you're thinking about it, not so much the generational thing, but the way that we should put together these conferences and focus may be in some ways just perpetuating some of the things that give us some difficulty. So I'll be interested in having this conversation and then having you tell me why I'm wrong later on. And I hope everybody joins in this, because I think Peter's put a lot of work into this, and there are some good possibilities to continue on. All right, so let's get to the meat of it. When you think about financial statement analysis and the evolution of the pedagogy involved, it really starts out in an organized way with an intrinsic value or value investor perspective. And it's heuristic in terms of the fundamental analysis that's done in the original textbooks. A lot of it is based on the experience of the people who wrote the books and their own sense from the anecdotal evidence of what is systematic and what is not. And some of the stuff sort of was codified in little rules and ways of thinking about the world. And there was a very strong normative flavor to that sort of pedagogy, which began with the idea that if you looked at a stock price, that didn't necessarily equal value. And the idea here was to try to uncover what real value was and benefit through trading and making arbitrage profits. When you look at these textbooks, it sort of follows the same organization typically of introductory and intermediate textbooks, where a lot of what you're talking about sort of goes through the different financial statements, the different sections of the financial statements. You'll go through the income statement. We'll talk about revenue recognition and expense recognitions. You'll go through the balance sheet and go through the assets and the current assets, the liabilities, etc. And when it's all said and done, it looks sort of like the first attempts to try to take introductory textbooks and actually interpret these things in the real world, as opposed to just have rules and talk about the articulation of the financial statements and double entry bookkeeping and so on. Then, in my mind, and so I'm talking about books like Graham and Dodd, which is now Cottle, Murray, and Murrin or something like that. And the next sort of big step for me was, I think, the Foster textbook in 1978. And one of the things that sort of set it apart from other textbooks was the use of empirical evidence and the introduction of theory to sort of motivate some of the things that we were going to be using as analysis tools and how to think about the world. And this book made a big splash. Am I revealing the fact that I'm really not a young guy right now? All right. Well, somebody gave me these slides. What was really unusual about the book was it stopped and it talked about theories and evidence and set it to financial statements. And it also looked at decision context specifically and brought the research to the decision context. And you see that in most pedagogy, at some point or another, we sort of get to this formulation where we organize our thinking around a decision context. And then the next sort of group of textbooks that came along sort of appealed to things like business strategy in order to provide frameworks and motivate our thinking. And in particular, I'm thinking of the Palapoo, Bernard, and Healy text in *96, which has been updated and is still out, and the Stickney and Brown text in 1998. Those two were sort of coincided, and they brought business strategy analysis and lumped it into fundamental analysis. And one of the things that it also did was it brought in accounting-based valuation, which played sort of a bit part in the book, but at least brought some meat to the book, and as it turns out later on, sort of made it the standard for most financial statement analysis textbooks that are connected to accounting. And then finally, the granddaddy of them all, in terms of frustration.
Because of age.
I know. It's an age thing with Stephen. Actually, I think Stephen wrote this book deliberately to ruin our friendship. And, I go back and forth with this textbook because it's a pretty comprehensive book. And there's an attempt in here to try to tie everything together. Stock prices to the financial statements in a way that is correct, if you will, and then to apply fundamental analysis to your thinking about things that relate to value. And in fact, it spends an awful lot of time using as a tool the accounting-based valuation methods that include things like the old residual earnings model as well, all the way up to sort of the abnormal earnings growth models where you toss the book value out. And it allows you to talk about things in a sort of a conceptually correct way that we often sort of deal with in an ad hoc way, things like PE ratios and price-to-book ratios. And so so that is sort of another kind of book. And what we have is essentially questions when you go through all the other texts that you look at about how you should organize the material, how you should emphasize the material. And almost every book that's come out during this time and subsequent to the Penman book has some element of the decision context. It has some discussion about specific topics like earnings management, earnings quality, disclosure, accounting choice. I knew I'd find a typo in there somewhere. Things like the effects of corporate financial policies. And in some sense, when you started talking about the conference, I started thinking, oh, we're going to have another conference with sort of a subtopic of financial statement analysis, something like, one day we'll have the earnings quality, conference. And that sort of made me feel uncomfortable. And as we go along, I'll sort of explain to you why it makes me feel uncomfortable. But it is interesting that when you look at the pedagogy, what we're seeing is that it both reflects the research that we've been doing for a very long time, and now it's actually starting to sort of impact the research itself. As you go through a textbook like Stevens, and you think about fundamental analysis, and you think about PE ratios and accounting-based valuation, you start to ponder certain questions that you'd like to know the empirical evidence, how that works out. And so in some sense, we're going back and forth between what we're teaching and the research that we're doing in financial statement analysis. And that's both good and bad in a sense that it gives us this organization, but I think it's maybe bad in the sense that it's locking us into the way we think about the world and the way we present the evidence. And it has a bigger effect in our research, I think, than our teaching. And I will mysteriously say I'll come back to that later on. Other things we see is there's some focus on a setting or event, an M&A situation, fraud, IPOs, MBOs, venture capital. And again, it depends on which textbook you're looking at, how much of a focus you're going to see on that. And then we have a question about what kind of tools that we teach as we go through this. There are certain tools that I sort of consider neutral. They're not in some cognitive sense neutral, but there's not much argument about whether we teach them or not. Things like common sizing and trend analysis, ratio analysis, using comparable firms and industry numbers for benchmarks. Then we have things that I consider to be more normative or sort of evidence-driven tools. For example, if I recast or convert a financial statement, I may not have an awful lot of evidence to suggest why I'm doing that, but I can show people how to do it, and sometimes I can even make them do it in class. And of course, when you think about it, when getting back to sort of Stevens' book and its use of accounting-based valuation, why are we recasting something if the accounting doesn't matter? Presumably we're doing it because it's helping us think about forecasting. But it's still a question of, do we need to go through and do that sort of thing? And so I never say this to my students. I just say, okay, here's how you do it. And then I talk about how things look different. But I really don't get into the subtleties of whether or not accounting matters if I'm coming at the world from a market efficiency perspective versus a market inefficiency perspective. And the same thing's true with a lot of the other tools that I use. And sometimes, it's driven by things like information that we have from the empirical evidence and research about whether fundamental signals tell us anything, or red flag analysis works, or what we know about the effects of restatements and that sort of thing. But again, these tools don't seem to be all that neutral, and we sort of talk about this stuff as if we know what we're doing when we're teaching it, which is, partially correct, I think. Pro forma analysis is another tool. I think that we could do a lot more than we do in textbooks. And I think we need to think a lot about forecasting. It's one of the reasons I'm really happy that, they have a separate section on forecasting. And we do that sometimes by forecasting out converted statements, or we don't even care what accounting we're using, just as long as we use a consistent accounting and we forecast it out. That's another tool we spend a lot of time with. And then there's the monster of all time, accounting-based valuation. Now, for those of you who are old enough, when accounting-based valuation sort of became an interesting subject in research, there was an awful lot of pushback against it. I'm not going to name any names here, unless, of course, somebody gives me trouble. But there was a lot of pushback in the sense that people kind of knew that it was algebra. And if it's algebra, then it's not a theory. All right? Now, the nature of the algebra is such that you can move things around and think about the world in specific ways, and maybe test theories with it. But it's not, in and of itself, a theory. Now, you can tack something on like linear information dynamics and maybe move towards a theory of some sort. And so there was some confusion, I think, when this literature first started to arise about what it was to be used for and what it was going to tell us. And I think people were sort of talking at cross purposes about that. In some sense, it's great because the good news is accounting doesn't matter in a lot of settings that we're talking about when we're teaching it. And that's also the bad news, because what we can't do is rely on the model to do our thinking for us. We can only use the model to sort of tell us something about when accounting might matter. And so there's sort of a conundrum when you go to get ready to teach this stuff about how hard you want to push it and what it is you want to accomplish when you're using that tool. The other thing is, I'm not quite sure, and maybe Peter knows more about this and the last two panels can talk about this. I'm not quite sure I understand the extent to which this tool has really gained acceptance in the real world. So I know that we've got a specific panel made up of people like Trevor, who have lived and breathed this accounting-based valuation for a long time. And Charles, I think, is Charles here? Good to see you, buddy. And Charles, who does more than live and breathe it. And so we know that we already have friends of accounting-based valuation here. But what I don't know is, after you get outside of our little circle of scholars, how far it's going. And one of the things that would be sort of interesting to know is how much of an impact this stuff has had. And I know that while we're talking about it in terms of valuation, some of these tools are used for, the structure of these tools are used for other purposes, and there's a panel that Catherine is going to what are you going to do with this panel, Catherine? All right, she's going to moderate this panel, and I think some of what she's going to do is going to talk about variations of these models and used in things like enterprise performance evaluation. And again, we sort of know that stuff's being used out there if you go look at the Stern-Stewart EVA. But again, we don't know the extent and the impact in the real world. It'd be interesting to know, because one of the problems we have is when we're trying to motivate this stuff in class, and what purpose we're using it for. And sometimes we may love the tool, and they may not actually be using it in the real world, and sometimes that creates consternation. The other thing we see in these textbooks is a lot of discussion of theory and concepts. When you, for example, linking theory to concepts in the empirical world, when we talk about signaling theory, or when we use market efficiency as a way of starting out our thinking, these are things that we talk a lot about in textbooks and in courses, and it's one of the things that sort of floats onto the surface that's more prevalent in accounting textbooks and finance textbooks and so forth. We also integrate a lot of economic finance strategy in the tools, in creating the tools and motivating the tools we're using Things like using CAPM in valuation models, things like relying on Miller-Modigliani to separate operating from financing and so forth when we build our models and our spreadsheets. We also spend, depending on the textbook you're looking at, varying times on examining a body of rules and standards, and to some extent also thinking about the logical foundation of those rules, when those rules sort of work for us, having the system in place as well as having specific rules around, and when maybe there might be a shortcoming of those rules. But we don't really go very far anymore down that path in financial statement analysis, but it's a good way to sort of bring up issues that come up in class and sort of motivate other discussions. And then the other thing we see a lot of is some textbooks tend to focus more on firm-specific types of analysis, forensic approaches, firm by firm. We use case studies in some books, especially at the end of chapters, to sort of reinforce ideas and different messages we're trying to get across. We have contextual analyses that are done to a greater degree in some textbooks and in some courses as they're organized. And then we have other things where we're trying to sort of get at broader applications, large sample evidence that's being introduced to motivate what we're doing, or maybe if it's it's some sort of trading strategy, portfolio analysis, and so these are sort of the basics of what you find in varying degrees in terms of the content, the method, the emphasis of the materials in financial statement analysis textbooks. Now, since a lot of people are in here that are sorry, somebody unplugged me, I think. Let's see if that, yikes. Here are other textbooks. So I didn't want to slight anybody here. Okay? And Peter, I just saw the textbook and the wild thing. Oh, man. You are, okay. All right, so the whole thing's over. It was good to have you here. Good night, everybody. Does this look anywhere near where we were? Righty. You get to see everything. Where's the audio-visual person that's supposed to come up and save me? You rat bastards. Leave me hanging out here to dry. It's not what you said last night. All right. Factors affecting, there's some factors now that we have to keep in mind. I'm not so sure I want you to end because you're mad at me right now. Factors affecting, I want to talk about the factors that are affecting this trade-off of what we find in books and what we choose to do in specific classes. One of the things that I think has been the biggest impact on me and my teaching and what I've seen in other schools is financial statement analysis is no longer just a class or a thing you do in a textbook. Wherever you go now, even in introductory classes, you find that there's a lot of financial statement analysis going around. So I'm not even sure it's a separate topic anymore. I think it's sort of in the woodwork everywhere. And that affects what we do when we teach and what we think we're doing from one class to the next. And it also is affecting our research in the sense that almost anybody who's teaching anything close to a financial accounting class is likely to be doing something either in their research or in their teaching that is, in fact, financial statement analysis. We see there's a big increase in demand for international content. And that gets that's pushed not only because we have a lot of more international students in our classes. It comes down through dean's offices. It comes into curriculum through curriculum committee, and students themselves want to see more of it in classes. The other thing that sort of makes teaching financial statement analysis interesting these days, in my mind, is the design of curricula and the differences we have in programs, the number of programs that we have in business schools. teaching graduates is a little bit different from teaching undergraduates. And I know there's some survey papers out there that are, limited evidence, like I think Stickney has one of these, that talks a little bit about, how what we do in the classroom varies depending on whether there's a graduate student or undergraduate in there. How you teach an executive education and treat financial statement analysis is very different, especially when you go between degree programs and custom programs. And then there's this question of how much in the curriculum specialization is going to be done versus general knowledge. In some schools, you are, cutting the whatever fruit we're talking about here pretty thin, having very boutique-like classes that are very, very popular, but it would be very difficult to say that any of those classes are filling in an idea of a general curriculum. And then the other thing that seems to be going on here is shorter class durations. And this is a big challenge. If you're trying to teach something like Steve Penman's book, or you're trying to really acclimate people to the exercise of financial statement analysis, and you've got them for 7 weeks, we're talking about like the average time I date women. And that is too short. I'm sorry, Peter told me to use that line. All right. Other thing that we see, and this gets to every time you see a fish with a hook, it's about what this conference, I think, is about. Increasing demand for post-degree training among a lot of different types of clienteles. And the fact that we still get a lot of clamoring in the classroom from students and employers to make coursework more immediately relevant to their jobs. And so one of the things I think that these CARE conferences should be able to help out a little bit is thinking about how we're going to try to bring more relevant material in an environment that is becoming very complex, where there are lots of pressures that are affecting what we're choosing to do in the classroom, and we don't even know what the guy teaching the introductory course down the hallway is doing to us in the process. And so what is relevant is something we need to start thinking about, and to some extent, I know there are other mechanisms out there, other venues where people share cases through electronic subscriptions and so forth, but in some sense, maybe one of the things that we can do through a series of conferences is understand a little bit more about what the pedagogical issues are and share that kind of information and improve our teaching. There's also a much more complex environment when we think about the demand for what we do. These are always, if you go down any textbook, and I don't mean to be disparaging here, any textbook on financial statement analysis has the demand and the supply for financial statement analysis. And they all have the list of these are the guys who have the demand for the financial statement analysis. And when you go down that list, it sort of makes sense, and you imagine in your mind, there's this analyst who's looking at financial statements. And then there's this guy who does, trading, and he's looking at financial statements. And we have sort of a generic notion of all of that. But what we're seeing is much more complex business environments than we've had in the past. We're seeing situations where the rules and standards are proliferating. We have very, very difficult measurement issues like stock options, pensions and post-retirement benefits, derivatives, that are making jobs a lot harder. And what you're seeing is there is what I see is not only an increasing demand for FSA, but more important, there's an increasing diversity in the people who are demanding it. So if you just look at equity investors alone, these guys vary by size, what side of the market they're on, the type, the style of their investing. And I'm hoping Bruce is going to talk, so I'm going to just shut up about this now. And in some sense, what we're trying to figure out in both our research and our pedagogy is to how we deal with this more complicated landscape. And one of the things I think that the more about that. But as it turns out, as this more complex world is evolving, we are only a few. We're like the Spartans. Okay, forget the Spartans. I can't blame that one on Peter. I'm going to have to go with Jim on this one. That was Jim's fault. So researchers, we don't grow or contract very fast, right? And so we're dealing with this very complex environment, and we got the old usual suspects in mind, but I think we need a little bit of help here, sort of thinking about the way the world is changing, and more important, I think, our reward structure hasn't changed very much. We're getting paid a lot more for doing the things that we've been doing, and nobody seems to be kicking us out. All right, so the incentive to go out and do some of this stuff might be a little lower than you think. All right, so then there's the search. How much time do I have here?
20 minutes.
20 minutes? Man, I'm so ahead of my schedule right now. You guys mind if I take a sip of water? Thank you very much. I have no idea where this thing is going to end. All right, so if I'm talking to real-world people and I'm looking for more real-world relevance, one of the things I'd like to sort of have in mind is, how bad am I? I'm not that bad, I think I'm okay. One of the things I need, maybe as an instructor and maybe as a researcher, to do a little better is to understand that world that's out there and know what it is that people want from me a little better. And like I said, the conferences can help in that regard. But one of the most important things that we are doing is bringing our research into our pedagogy. So people seem to be, when I hear consternation from real-world people in the world, they seem to be a little upset that we're not quite getting something done that we need to be getting done. Maybe we're not directly, we're not giving them specific skills that they need. But there is no doubt in my mind that as we have incorporated research into our pedagogy, that we have, in fact, improved what people know when they go out in the real world. In fact, there's a certain base level of knowledge that I think that we do communicate that is important here. But to the extent that we want to think more about how we're using research in pedagogy, I think, again, the CARE conferences are a way to sort of maybe codify some of that, summarize that, identify what it is that we could do for different types of clienteles. But for the most part, when people come to me from the real world and bellyache about what I'm doing, I usually tell them, I'm doing okay. And so I'm not all that frustrated. It's frustrating trying to think across all the different tools and concepts I can teach what I should do in a classroom. But it's not, but there's so much there, that's where the frustration comes, not from the idea that my students are going out and they don't have any skills and they wasted all their time in class. And I don't like to confuse those two things, the difficulty of trying to find out what I do in a classroom with the idea that somehow or another what happens to the students is they get a poor educational experience. So in some sense, I think we do this pretty good right now, and I think maybe we could do a little better, and CARE conferences are one way to improve that. Then there's the old direct products. A lot of times when people say, we need more real-world research that can help us, the first thing that comes to mind is you say, what did an academic do in a paper that somebody in the real world could just extract and exploit in some sense? And direct products, there are some literatures that are sort of tailor-made for that exercise. For example, when we look at counting-based anomalies, things like PE anomalies, the post-earnings announcement drift anomaly, those literatures are very much lined up with what people do in certain types of investment, equity investment. And so you can see where that, where you would expect some of that to happen. And then fundamental analysis is another place where we do the kind of research where people might use it in the real world, especially when it comes to helping with forecasting. You can maybe predict or uncover through some sort of data-driven method whether somebody's engaged in fraud. But I think we have to have sort of realistic expectations about this endeavor. The first thing is, it really is a matter of personal taste and ability. What I'm saying is that some of you people out there aren't as smart as you think you are. And I don't think I'm as smart as I think I am either, okay? So in some sense, some of the things that we want faculty to do, they're just not going to do it. They can't, all right? I'm not saying they're dumb as a box of rocks. I'm saying that their mind works on different things instead of just like heavy, intensive, computer-driven trading strategies, okay? They do something else better, all right? And then also, it's a matter of personal taste sometimes. The idea of sitting down and working on that sort of thing to create a direct product is, sort of foreign to a lot of us. And again, since we're paid to do certain things like do research, whether it has any direct relevance or not, immediate direct relevance or not, it's going to be hard to change those personal tastes. All right, I'm sorry for calling anybody out there stupid who took it personally. But if you did, I guess that says something. For the moment, then our incentives are not really designed towards doing direct products unless we really want the cash or, the self-esteem, whatever it is. Of course, that self-esteem lasts as long as, the portfolio is doing well. And also, I think we should think about the path when we think about how we want to be more relevant. The path of research to the real world is not as obvious as it looks. All right, even if you take the case of trading strategies, and you think about post-earnings announcement drift as a successful strategy, it's not like Jake and Vic sat down and made this stuff up. Well, I guess they did, but it's not like they did it without a bunch of stuff happening. Ray Ball had to write this paper with Ball and Brown in 1968 before the idea of thinking about something drifting actually, made any sense. And there were a bunch of papers in between, and it's 20 years later before Bernard and Thomas start talking about post-earnings announcement drift, and then people start trying to do trading strategies on that sort of thing. And it's not like the accrual anomaly, whatever whether it's accruals or something else that's causing it, it's not like that came out of nowhere. And there was an awful lot of research that went on, and it's hard to know what the linkages are. An example, this morning, I get in the shower. I'm put shampoo in my hands, and I'm thinking about, am I going to get these slides ready for this talk? And I put the shampoo on my head, all right? And it sits there for a minute, but I don't do anything. And without even thinking about it, I reach for the conditioner bottle, and I put the conditioner on my hands, and I put that on my head, and I start smearing the stuff together, and I think to myself, epiphany. I have invented shampoo conditioner, all right? That's kind of, these epiphanies that we're looking for don't really happen that way. And in some sense, you need people to do some pointy-headed work, too. I know there's a lot of people out here who don't like analytical work, all right? I feel your pain. But I don't necessarily sympathize with you because I kind of love that stuff. I'm going to admit something right now. I like that Fellingham-Aria paper with the separating hyperplanes. It made me feel good about myself when I read that paper, all right? And I don't mean to be derisive about this. I think that it's really hard to know where the connections are. And the idea of sitting down and taking a bunch of theory papers and trying to pick them apart because they don't seem to be specifically relevant to anything does, in some sense, preclude the possibility of inventing shampoo conditioner if you don't know where all the dots are connected. So maybe a little soul searching is required, though. Maybe we're not quite as productive as we ought to be. Maybe we could be more sort of relevant to the real world. Because I think, and I'm going to say this, I know it's true among colleagues in other fields that everybody's whining about what they do. And everybody whines about what everybody else does. All right? That's just a fact. But I do get the sense sometimes that we whine a little bit more than most. All right? And I also, other than John Hand, who is obsessively happy for reasons that are beyond me, most of us have some kind of difficulty thinking about our relevance and whether or not we're doing anything meaningful in our research. It comes up a lot. And I don't actually hear that a lot from other fields. So whether this is the same problem that happens in every scientific field, or whether we are worse than everybody else, I'm going to sort of go under the assumption that if we recognize some of the things we do wrong, we can get better. And I think this is tied to some extent to what Kathy's going to talk about a little later on as well. So, I never did figure out a name for this slide. So that was the placeholder, and I kept it. We're actually much more nimble in the way we use theory and research tools in the classroom than we are when we do research. We're great at it. We go in and we do things like one day we have this problem of trying to measure stock options. And so we go into Stephen's textbook and he's got like 5 ways of doing it. All right? Some of them are really tricky. One of them is really simple. Assume market efficiency and work from there. Okay? And why do we need to figure out these stock options? Because we're doing valuation. And part of the valuation is the value of the stock options. And why are we doing the valuation? Because it's maybe an intrinsic value that we're trying to get at. But what are we going to do? We're going to use market efficiency to come up with our assessment of what the stock options are. All right? We're great at that. We take a stand. We pretend that there's not an internal contradiction there. All right? If we didn't, the students would really look at us funny. All right? And we do that stuff the very next day. We go out and we teach them something like a trading strategy that says we're going to go beat the market, even though we just did stock options with an efficient market. Okay, but we're really good at that. We do dancing. If we're doing ratio analysis, one day we're saying make sure you start with the beginning balance and get the flow from that. Get that straight. Get the operating separated from the financing. Get that clean for the valuation. And the next day we come in and we teach them distress prediction, where they're using ending balances from the balance sheet to calculate the ratio that mixes up financing and operating. We have no shame, which is a good thing, because we would go nuts if we didn't. But perhaps when we think about doing our research, we're not so aware of the fact of these internal inconsistencies. We know when we're making stuff up and taking a stand that we don't have to in the classroom. But I suspect that we're not very good, and this is part of this angst problem we might have, at understanding the internal inconsistencies in the way we've structured our research and what's going on in what I'd like to think of as different stovepipes. For those of you who are into national intelligence and stuff like that, stovepipes I'll talk about them. All right, so we're not doing enough challenging of ideas. We're not destroying enough ideas in this business. That's what we should be doing too. And maybe we should do a little bit more synthesizing in our research. And one of the things we can do in this conference is think about that. Not just have a conference about forecasting or about value relevance, but think about how the evidence across those two literatures and how we structure the empirical designs and the beliefs that we have when we do that research are somehow connected. Because we're missing some opportunities doing it. All right, so people have seen this before. Start reading. This is a famous fable. I've done this before, one other time, been slapped around. I'm going to try it again. So this is the old fable of the 6 blind men who come to see the elephant. And the first one comes up to the elephant, and he touches the side of the elephant, says, the elephant is a wall. The second one feels the tusk and thinks, oh my goodness, what we've got here is a spear. The third one squirms around a little bit here with his hands, and he figures out that, we got a snake on our hands, depending on what part of the elephant was touched. Now, I could keep going on, because there are 6 of these verses, but I'm running out of gas, and I'm running out of time. So I'm going to skip them, and I'm going to say that's the punchline to this Jeffrey Sachs poem from the turn of the last century, where everybody is kind of right, but everybody is kind of wrong in what we do. And so when I think about financial statement analysis research, and I look at it, I say we're almost to the point now where we don't even listen to what's going on in the research in one area when we're doing our own. And there are some real serious problems with that. For example, and I'll do this because it's sort of near and dear to my heart, and Mark is going to talk about analyst forecasting later on, and maybe he can elaborate on this sense. When I'm doing analyst forecast research originally, the question that people had in mind was, what's going on with the forecast, the F? Is it the case that those forecasts are rational, or are they biased and inefficient? And remember, what they thought about was F. Then we went through years and years and years of research, and the way we evaluated the evidence on whether F was unbiased and efficient or vice versa, I guess I can't do vice versa there, but you know what I'm trying to get at, is to look at the difference between the forecast and the actual earnings, the forecast error. We used that. And if those errors had some unusual properties, we said there must be something about the forecast that is irrational. And we had a lot of literature and a lot of papers that said this stuff is really irrational. And then we've got the ERC literature that wants to look at the information content of earnings, looking at announcement returns, right? In the analyst forecast literature, we treated the earnings as unbiased and okay, and we were making inferences about the forecast. In the earnings response coefficient literature, we wind up pumping in analyst forecast to be the expectations measure, and the actual earnings is what we're trying to find out if it's been biased or manipulated in some ways, and we want to see what the stock price effect of that is. These two literatures are completely at odds. The forecasting literature wants to know whether something is biased or not. And they come to the interpretation that it is biased. And then the ERC people use it as if it's an unbiased number and want to see if the A is changing. All right? When I look at the interpretation from the evidence, I've used F minus A, forecast minus actual, in both literatures. But what affects them and what's really going on, I'm not so sure. I can have a different opinion. I've done some research where some of the people that do the things that I do are coming to the conclusion that maybe the forecast isn't very often all that biased, and that it's really the actual number that is driving our forecast error results. If you look at the world that way, then I can connect it up with the ERC literature and what we see as non-linearities in that literature. And I can carry it even further to why the A is really driving things and not the F. And that comes from the earnings management literature. And so what I'm getting at here is that we don't know much about what other people do. And we often assume things that are exactly the opposite of what people believe in other literatures. And I could go through all day long and show you examples of how that works. And what's going on is, I think, we're not getting as much value out of specialization as we ought to. In fact, we're starting to feel the cost of compartmentalization. And so one thing you should be able to ask yourself is, to what extent is specialization expected to lead to internal contradictions? Do we specialize to the point where the general body of knowledge becomes internally inconsistent and we throw it away? Or should we be just advancing things to sort of push the edges of the literatures that we're looking at? And right now, I don't feel all the time, on most days, that our specialization is getting us as far as we ought to be. And in some sense, it's becoming more like compartmentalization. And I think the CARE conference has the ability to maybe bring this out a little bit more, so we're talking better across these literatures. And maybe get some benefits out of this. And here's the other thing that's sort of going around, and just admit it because it's true. Nobody likes the analyst forecast literature except for analyst forecast researchers. Okay? We become dismissive or disdainful about other literatures because we can fight within our own camp. But if any other camp comes in here and messes with us, we're going to get pissed off, right? And moreover, every other camp is going to look at every other camp and say, the hell with them, right? But in some sense, we're all sort of doing the same thing. This is starting to sound like one of those like motivational speaking things, so I'm going to quit right now. My point is, there is some spilkus that comes out of this compartmentalization that sometimes gives us the idea that what we're up to may be a little bit too, is getting us bogged down. So maybe CARE can come to the rescue. All right, I'm going to do some finishing up here. How much time do I have to finish up?
2 minutes.
2 minutes? All right. Don't think of the elephant. Just kidding. I actually do want you to think of it. All right. I think we should spend more time developing and destroying taxonomies. I don't think we do a very good job with taxonomies. I'm scared right now to click the hyperlink because I only have 2 minutes. But it was an example of a taxonomy that I developed as a graduate student and still use today in the earnings management literature. And the purpose of that taxonomy is to read each paper and find out how much of what is in that paper I can actually interpret as earnings management and the purpose of earnings management and the impact of earnings management. What I find, for example, in the earnings management literature and a lot of other literatures is people say things they don't need to say for the results and the tests that they do. Many times when you read an earnings management paper, and I'll just do one example, there's this tone of earnings management is evil and somebody's acting opportunistically. And we know there are all sorts of other papers that don't look at the world that way. They say it. Then they go out and they do their test. And you can see that while they might be presenting evidence of manipulation of some sort, while they might be able to present evidence of some impact in, let's say, a stock market, what they can never do is say anything about what the motivation for that earnings management is. So if we had better taxonomies, we wouldn't be carrying all of our baggage in each time we go to do the research. We would be able to sort of say, okay, tick it off. This paper does this and this, but not this, this, and this, right? And we would then be able to identify in sort of a meta-analysis framework more than what we have identified up to this point. I think we need to get closer to a common language and agreed upon definitions. I think one of the problems we have are certain things just get in the way. And I'm going to make a statement here that is controversial and that I hope Kathy talks about it more. It's right there at the absolute bottom here. All right? I see everybody doing that, so I'm messing with you. Maybe it's time to vote the term earnings quality off of the island. All right? Now, that's going to be very uncomfortable if you've got a conference on earnings quality. But if we do have a conference on earnings quality, I think a handful of us should be allowed to come in and be rabble-rousers and say the hell with it. There are better ways to think about the things, the many things that we call earnings quality, and compartmentalize that or specialize in that and then work sensibly through it. And in some sense, the language itself kind of gets in the way because it drags everybody's beliefs about what it means into a discussion about a test that can only test one or two possibilities. And so that's another thing that I'd like to see us do. Expand our horizons a little bit. I hear interdisciplinary work a lot, but I think the problem when you try to do interdisciplinary is to try to find something that people have in common that makes sense. But one example would be like forecasting. We do forecasting, and we do it in an accounting way, okay? But there's an incredible literature out there in the cognitive sciences and statistical sciences that we do not use in accounting, that we ought to be using. And so if you're having a financial statement analysis conference, then maybe making something about forecasting go across disciplines so we can bring in some of that knowledge would be useful. Duran's probably going to talk a little bit about that. And then one last point I wanted to make. I hated behavioral literature when I was, well, I guess I'm young, so even younger than I am. And a lot of that was, the taste of the people who taught me as a graduate. And some of it was because I just didn't understand the stuff. And some of it was because that stuff, as it took off in the accounting literature, was pretty, infant and infantile at times, it seemed to me. But the older I look at the question is, if people are going to say stuff is happening for behavioral reasons, how we react, for example, to a particular standard and how we report something, then we better start understanding those theories better. So one of the things you can do at one of these conferences, which sort of inverts the process, is to say, we want to talk about the subject of financial statement analysis, and we want to have the best behavioral people talk about what they know in front of everybody else who doesn't know anything about behavioral research. I would like to see something like that. And then I would like to see us think about these areas that are burgeoning now. that a lot of capital markets researchers seem to be missing. Taxation seems to be big. If you look at what's going on at NBER right now, and a lot of the researchers in accounting, there's a splintering going on. They sort of have one foot with the rest of us and another foot with the economists. And there are some really important things that that apply to trading strategies, if you're an arbitrager, or just how you do good forecasting that I think we can learn from that group. Public policy is another big one, and I'm sorry for going over.
Please join me in thanking Jeff Abarbanell.